Today, February 28, 2026, the Optimism token, OP, suffered a sudden, dramatic price drop, stunning the crypto market. The OP token, which had been trading with relative stability for weeks, suddenly found itself at the center of a whirlwind. Traders and investors woke up to a sea of red, with headlines flashing warnings of a major crash. The speed and scale of the drop caught even seasoned market watchers off guard, raising urgent questions about what could have triggered such a sharp reversal. In just 24 hours, OP plunged 15%, crashing to around 15 cents, a level few expected to see again. This wasn't just a minor correction, it was a dramatic collapse that erased weeks of gains in a matter of hours. For many, the suddenness of the move was reminiscent of previous flash crashes that have rocked the crypto world. This wasn't a slow decline, it was a rapid, forceful plunge that left traders scrambling for answers. Panic selling set in almost instantly, with stop-loss orders triggering a cascade of further drops. The market's reaction was swift and unforgiving, amplifying the sense of chaos. Such a steep fall signals a massive wave of selling, overwhelming buyers, and shifting sentiment from optimism to fear. The order books were flooded with sell orders, and buyers quickly retreated, unwilling to catch a falling knife. The mood across trading floors and online forums shifted from hope to anxiety in minutes. When a leading Layer 2 token crashes, it shakes confidence across the entire altcoin sector. Other tokens began to wobble as well, with investors fearing a domino effect. The interconnected nature of crypto markets means that a shock in one area can quickly ripple out, impacting portfolios far beyond just OP holders. The event is a stark reminder of crypto's volatility and the risks that come with it. Even established projects aren't immune to sudden shocks. For newcomers and veterans alike, days like this highlight the importance of risk management and staying informed. For investors, understanding the reasons behind these moves is crucial. Was it a technical glitch, a whale dumping tokens, or negative news spreading fear? Digging into the causes can help you make better decisions and avoid emotional reactions. At Crypto Insider, we're here to break down what happened and what it means for you. Our team is analyzing the data, speaking with experts, and tracking the latest developments to bring you clear, actionable insights. Let's dive into the forces that triggered this market shock, explore the underlying causes, and help you navigate the uncertainty ahead. To truly grasp why OP's price crashed so dramatically, we first need to understand the concept of support levels in trading. These are the price floors that traders and investors monitor with intense focus. Support levels are not just arbitrary lines on a chart. They represent psychological thresholds where buyers have historically stepped in to prevent further declines. When prices approach these levels, many market participants expect a bounce, and so they place buy orders or set up strategies around these points. But when a support level fails, when the price drops below this critical floor, it signals to the market that the balance of power has shifted from buyers to sellers. In OP's case, breaking a key support didn't just disappoint a few traders, it triggered a chain reaction. Automated stop-loss orders, which are designed to limit losses by selling when prices fall below a set point, all fired at once. This sudden flood of sell orders overwhelmed the market, dramatically increasing supply in a matter of seconds. This domino effect is what makes markets so volatile during these moments. As prices fall further, panic spreads. Traders who hadn't planned to sell suddenly rush to exit, fearing even bigger losses. The selling feeds on itself, accelerating the downward spiral. The combination of automated trading algorithms and emotional manual selling creates a perfect storm. What might have started as a minor dip quickly snowballs into a full-blown crash, with prices dropping much faster and further than anyone anticipated. In the world of crypto, these technical triggers can ripple outwards, causing synchronized drops across multiple assets and exchanges. Fear spreads rapidly, and what began as a technical event becomes a market-wide phenomenon. The speed and scale of these moves are amplified by high-frequency trading bots and the instant flow of information. News, rumors, and price alerts travel at lightning speed, making it nearly impossible for human traders to react in time. That's why understanding this dynamic is absolutely critical for anyone looking to manage risk in volatile markets. It's not just about setting stop losses or watching charts, it's about anticipating how the crowd will react when key levels break. Stop losses can be a double-edged sword. While they're designed to protect you from catastrophic losses, they can also intensify market instability by adding to the selling pressure at the worst possible moment. The key takeaway? Technical levels like support and resistance matter deeply, but so does the psychology of the crowd. Markets are driven by both numbers and emotions. Next, let's dive deeper into how emotions and herd behavior can drive these dramatic moves even further, shaping the fate of entire markets in just moments. OP's crash is as much about psychology as it is about price charts. In today's hyper-connected digital world, information spreads at lightning speed, and so do emotions. The moment a major token starts to fall, news and rumors ripple through social media, chat groups, and trading platforms, amplifying anxiety and uncertainty. Traders and investors are glued to their screens, watching every tick, every red candle, and every headline. The fear of missing out on selling before prices drop further can be overwhelming, and it's this emotional response that often drives the most dramatic moves in the market. When prices fall fast, fear takes over. Traders see others selling and rush to join, driven by FOMO and panic. This creates a feedback loop, where each new wave of selling triggers even more fear, causing the crowd to act almost as a single organism. This herd behavior creates a self-fulfilling prophecy. Fear of a crash causes the crash. The collective mindset magnifies every move, turning a dip into a plunge. After a shock like this, traders often rotate out of volatile altcoins into safer assets like Bitcoin, Ethereum, or stablecoins. This flight to safety is a classic response, as people seek shelter from the storm in assets perceived as more stable. This risk-off shift deepens the sell-off and can leave a cloud of doubt over the token for weeks. The market's mood turns cautious, and confidence takes time to rebuild. Burned investors hesitate to re-enter, and new buyers wait for stability. The memory of sudden losses lingers, making everyone more careful and less willing to take risks. The result? Prolonged uncertainty and sideways trading. Markets can drift aimlessly for days or even weeks as participants wait for a clear signal or a shift in sentiment. Understanding these psychological cycles is key to anticipating what comes next. By recognizing the signs of fear, panic, and recovery, traders can better navigate the emotional waves that drive the market. It's not just about numbers, it's about crowd reactions. Every chart tells a story of human emotion, collective decision-making, and the powerful influence of group psychology. Next, let's see how trading volume reveals the true story behind the move, offering clues about when fear is peaking and when opportunity might return. Trading volume is the market's megaphone. It tells us how many are buying and selling. OP's 15% drop came with a huge spike in volume, confirming this was a broad-based, conviction-driven sell-off. High volume on a down day means the new, lower price is widely accepted, making quick recoveries harder. Many new holders bought at these lower levels and may sell on any bounce, creating resistance. If recovery comes on low volume, it's likely weak. On high volume, it signals real buyer strength. That's why volume is crucial for spotting trend changes. It separates minor dips from major shifts. Now let's talk about why volatility is part of the crypto journey. A 15% daily drop may seem wild, but volatility is the norm in crypto. Like a roller coaster, the market's highs and lows are part of the ride. Seasoned investors expect and manage them. Crypto's 24/7 nature, global news, and retail-driven sentiment fuel these swings. This isn't unique. Think of the dot-com era's wild price moves as the market searched for true value. Volatility creates both risk and opportunity. The key is to have a clear strategy and avoid panic selling. Those who stay calm and focused on the long term are best positioned to benefit. Volatility isn't the enemy, it's the price of potential reward. Let's look at the key levels that could shape OP's next move. After a crash, traders zero in on key support and resistance levels to predict what's next. For OP, the 12-cent mark is the critical support. If buyers step in here, it could signal stabilization. Sideways trading and lower volume at this level would suggest panic is fading. On the upside, 18 cents is the new resistance. If OP breaks above this on strong volume, recovery is likely. Old support often becomes new resistance as previous buyers look to exit at break-even. The battle between buyers and sellers at these levels will set the trend. A failure at 12 cents could mean more downside. A strong bounce and break above 18 cents could start a new uptrend. We'll be watching these levels closely. Now let's talk strategy for navigating this volatility. In times like these, stick to the fundamentals. Watch support, resistance, and volume. Don't let emotions dictate your moves. Let the data guide you. Monitor if OP holds support or breaks resistance, and pay attention to volume for confirmation. Volatility is normal in crypto, and disciplined investors see opportunity where others see chaos. Use this moment to review your risk management. Don't overexpose yourself to a single asset. Diversification and a long-term view are your best defenses. Stay informed and analytical, not reactive. At Crypto Insider, we'll keep you updated with clear, timely analysis. Focus on the facts, cut through the noise, and make confident decisions. Stick with us for the latest on OP and the broader crypto market.